All right, this week, the Trump administration decided to press pause on tariffs on some Chinese electronics and other consumer products until mid-December. The move had a big impact on a number of stocks, namely shares of Apple. But with those tariffs merely on hold, how should Apple investors be viewing the company's relationship with China? Joining us now to discuss is Loup Ventures managing partner Gene Munster. So, Gene, you say that China is a unique positive for Apple's long-term growth story. Just as far as you see it right now, the company's relationship with its consumer in China, where do you think things stand?
Surprisingly good. I think we looked at the last quarter, went from 13% of revenue to 17%. Most people were expecting a drop in the China revenue. So I think that is indication of the strength of the Chinese consumer was most surprising, and one of the reasons why Apple stocks performed relatively well over the last month.
Hey, Gene. So in terms of the tariffs, obviously Apple being pretty affected by the announcement earlier this week that they would be delaying on some products, not all products, to December 15. How did that affect, given that we know that the MacBook and iPhone should be all right through December, but that products like the Apple Watch and the AirPods won't be by September 1st?
I think this is a critical misunderstanding. Ultimately, Apple products really don't have much tariff risk. And the reason that is that Apple is really an iconic U.S. brand that the U.S. government doesn't want to jeopardize. And so I think that that's largely missed in this whole conversation. We don't expect tariffs on Apple products.
And so then, Gene, kind of moving away from Apple's relationship with China, just let's talk about where the company is in its overall life cycle, right? It's really, I don't know where you'd put it, early, middle of its shift towards emphasizing its services business. We continue to see revenue in that segment rise. I mean, what do you think Apple looks like in 2 or 3 years as we see the company continue to emphasize products that are not the iPhone?
Well, it's iPhone and services and wearables. Those two are probably, call it 25% of revenue, growing at, call it 50%. I think that's one of the important X factors that's ultimately going to lead to a higher multiple for Apple. If you think about this, most investors view Apple just as a simple hardware business. But when you look at services like you talked about, 17% of revenue, growing at 18% last quarter. Wearables, call it 10% of revenue, growing at 50%. This is very different than your typical hardware type of story. I think it's an important point as investors think about the long-term potential around Apple. Let me just put some quick context around that. When you have a business that has hardware around the iPhone, wearables and services, this ultimately becomes a consumer digital company. This is not about a hit-driven device company anymore. And I think that the key misunderstanding, what I would call an injustice, with Apple shares is that investors continue to view this as a hardware company. If they would view Apple as a consumer staple company, for example, and give it a multiple similar to Coca-Cola, that would imply, call it a $350 stock. So what you're talking about when you emphasize services, and I would expand that to wearables, this is an important point of, I think, confusion on the street relative to where the story can go over the next 5 years.
Well, and I think I'm hearing this right, but is it sort of like, should I be thinking about the AirPods and the watch, even though they are pieces of hardware, really as more services products, because they expand where the Apple ecosystem sits on my body, right? It's no longer just in my pocket, but now it's on my hand, it's in my ears all the time. I mean, I see people walking around the office just with AirPods on. I don't know if they're listening to anything or not, they just have them.
I'll tweak that just slightly, is that the services business is just that services subscription type of revenue. The wearables piece, and most of that is Apple Watch and AirPods, that segment tends to almost have this halo effect of when you buy one Apple device, you end up buying other devices. And so it ends up having characteristics similar to a services business. And if I was going to put this whole concept around what I think is going to change how investors view the Apple Store over the next 5 years in the most simplistic terms, it's they will view the hardware business ultimately as a service, and that should yield a higher multiple. I understand that that is a hard message to take, especially regarding some of the complexities that are going on with China today, and I think some of what I would consider idle speculation. But ultimately, I think that this story is grossly undervalued at the, call it, $1 trillion market cap today.
Hey, Gene, so let's switch gears to Tesla. So currently Tesla year to date has 75% of the U.S. EV market share. That's quite a lot, but there's worry that maybe some other companies will take a bite out of that, like Audi, Jaguar, Fiat, Volkswagen. What does that mean for Tesla's kind of future projections here, and does that cause reason for concern?
So this is a great topic regarding what's ultimately going to happen on competition. When you think about Tesla, it's a pretty divided camp. Those, I would say, who are the supporters, generally thought of as like Kool-Aid drinkers, and then you have the detractors. There's really no one in between. I try to keep a clear view of what's going on here. I lean positive on the story. And one of the key areas that people have focused in on the past year is competition. More competitors out there. Specifically in the last year, it's gone from 11 EVs available in the US to 17, 11 to 17. But that really doesn't tell the whole story. During that time, Tesla maintained its 75% market share. And part of the reason is that even though they added competitors over the past year, really most of them aren't viable. Those are cars that cost $70,000 or more or had range of 130 miles or less. And so really you need to look at that sweet spot. There's 5 vehicles that fit below 40,000 and above 220 miles in range. And what that ultimately comes down to is if I went through those cars individually, I think the Model 3 ultimately stands in a class of its own, even amongst those 5. So to put this kind of in the most basic form is Tesla, yes, there is more competition. But I think that a level-headed person who's thinking about an EV really has one clear choice today, which is Tesla Model 3.
All right, Gene Munster of Loup Ventures, really appreciate the time. Talk to you soon.
Thank you.